How to use sector rotation to outperform the market. Hook. 0 to 5 seconds. Most people put money in an S&P 500 index fund and call it a day. But here's what they don't know. The same $10,000 invested in different sectors at different times could turn into $47,000 instead of $18,000. That's the power of sector rotation. And I'm showing you exactly how to do it today. Part 1. What sector rotation actually is. 040 to 230. Let me break this down super simple. The stock market isn't one thing. It's broken into 10 major sectors: technology, healthcare, finance, energy, consumer goods, industrials, materials, utilities, real estate, and communication services. Here's the truth nobody talks about. These sectors don't perform equally. Ever. At any given time. Some sectors are crushing it while others are sleeping. Sector rotation is literally just moving your money into the sectors that are about to perform best, then switching out before they cool down. Think of it like this. Imagine you could predict that technology stocks are about to explode for the next 8 months. So instead of holding a boring diversified portfolio that includes utilities and energy, you load up on tech. Then when tech starts showing weakness, you rotate into healthcare or finance before they take off. The real kicker? This isn't gambling. This is pattern-based investing. Every economic cycle has a predictable rhythm. When the economy is heating up, you want different sectors than when it's cooling down. When inflation is spiking, some sectors thrive while others get crushed. When interest rates are rising, certain sectors benefit. This is about reading the economic environment and positioning yourself accordingly. Part 2. The economic cycle and which sectors win. 230 to 415. Here's how the cycle actually works. And this is where the money is. Early cycle recovery. This is when the economy is just starting to turn around. Unemployment is still high but dropping. Think 2020 to early 2021. The winners here? Technology, discretionary consumer goods, and communication services. Why? Because consumers start spending again and companies need tech to adapt. This is when you saw stocks like Apple, Amazon, and Microsoft absolutely dominate. Mid-cycle expansion. Economy is humming. Unemployment is low. Consumers are confident. Industries like finance do amazing because banks are lending more and making more profit. Energy starts moving because demand is up. Industrials crush it because factories are running hot. Real estate benefits from strong consumer confidence. Late cycle. The economy is getting hot. Inflation starts creeping up. This is where utilities become attractive because they're defensive. Healthcare too. Nobody stops going to the doctor when things get expensive. Energy keeps doing well because demand stays high but supply is tight. Recession or slowdown. This is when everything flips. Consumer discretionary gets destroyed because people stop buying luxury items and upgrades. Tech gets hammered because companies cut IT budgets. But healthcare? Utilities? Consumer staples like Procter & Gamble? These hold up because people still need toilet paper, medicine, and electricity no matter what. Part 3. How to actually implement this. 415 to 545. Now here's where this gets practical for your actual money. You have 3 ways to do this. Pick one based on your comfort level. Option 1. ETF rotation. Download Fidelity or Robinhood. Instead of just buying SPY or the S&P 500, you buy sector-specific ETFs. Technology sector is XLK. Healthcare is XLV. Financials is XLF. Utilities is XLU. You literally just buy and sell these based on where you think the economy is headed. Simple. Direct. Works. Option 2. Individual stocks. If you know a recession is coming, Buy healthcare stocks like Johnson & Johnson or United Health before the rotation happens. If you think the economy is heating up, grab financials like JP Morgan Chase. If inflation is the story, load up on energy like Exxon or Chevron before the sector pops. You're just being strategic about which individual companies you pick. Option 3. Inside your 401k or Roth IRA. Most people think they can't do this with retirement accounts. Wrong. If your Roth IRA is at Fidelity or even a brokerage IRA, you can hold individual sector ETFs. You get all the tax advantages of the retirement account plus the returns from sector rotation. Here's the real move. Start tracking economic indicators. Look at unemployment reports. Watch inflation data. Pay attention to Fed interest rate decisions. When you see patterns forming, rotate your sectors. This doesn't mean trading every week. Good sector rotation happens over months, sometimes quarters. Call to action. 545-5 to 60. This strategy isn't complex, but it does require you to think differently about investing. Instead of set it and forget it, you're actually paying attention and positioning your money strategically. If you want me to walk you through exactly which sectors to buy right now based on current economic conditions, hit subscribe and drop a comment saying sector, and I'll make that video this week. Let's get you outperforming the market.